Good day, everyone. So, the question that I'm going to discuss today is from the topic Indian financial system. Now, the question is, what do you mean by financial system, and explain the components of financial system. So, when you start with your introduction, you'll write about that what is the importance of the financial system of any country, that because it is related to the use of savings and converting it into the investments that ultimately leads to capital formation. So capital formation consists of saving, finance and investment, and it is the financial system which channelizes, which put together all these three things, right? So if you look here, it comprises a set of components and mechanisms that allows economic transactions to occur. Now, if you see here, financial system is made up of two things, that is finance and system. Talking about finance or financial, it means your monetary resources, and system means set of interrelated institutions, market, dealers, agents, etc. So whatever is done by financial system is basically through its components, which are called its ingredients also. And you can make this diagram also, which shows that how financial system works. So these are the different components. Now we'll discuss all these components. There are four components and we'll discuss these components one by one. The first component is the financial institution. So the institutions which deal in lending and borrowing of funds, these are called as financial institutions, or simply you can say the institutions which deal in finance or money are called financial institutions. These can be of two types, that is banking and non-banking institution. To define a banking institution, you can say that an institution that accepts deposits, give loans, because these are the two main functions of any institution to be called as banking institution. These can be divided into three parts: commercial banks, cooperative banks, and development banks. Talking about commercial banks, an institution that accepts demand deposits and makes commercial loans and is regulated by a regulatory agency. And in case of India, this regulatory agency, as we know, is RBI. Now, these commercial banks can be scheduled commercial banks or non-scheduled commercial banks. Scheduled commercial banks are those which are included in the second schedule of Reserve Bank of India, and these are the basic conditions which must be fulfilled by any bank to be called as scheduled commercial banks. The very first is that it must be carrying on the business of banking. So very obvious, to be called as a bank, it must be doing the business of banking. And what is the business of banking? That is accepting of deposits and lending of money. Now, it is not necessary that only public sector banks will be called as scheduled banks. It can be a public sector, private sector, foreign bank, or a cooperative bank. And it must ensure RBI that whatever it is doing, that is, its operations are not harmful or detrimental to the interest of the depositor. It must be a corporation or cooperative society, and not it should not work as a single owner or partnership firm. Coming to cooperative banks, I would like to say that besides being regulated by Reserve Bank of India, as it is the apex body, and Banking Regulation Act 1949, these are regulated by Cooperative Societies Act 1965. These are mainly concerned with the development of the agriculture and rural sectors, and they work for the welfare of the society. And there is a three-tier body operating at district, state, and central level. The third category under the financial institutions are the development banks. These, as you can see, it is clear from the name itself, development banks are those which gives funds for the development of the economy. So they can give medium and long term loans, and they also provide refinance facilities. You can write the example of some of the development banks like IDBI, IFCI, Exim Bank, and not to miss NABARD. Basically, NABARD works for the development of agriculture. Coming to the category of non-banking financial institutions, before explaining it technically or going by some definition, I would explain it simply that any financial institution which is not doing the business of banking is called as non-banking financial institution. For example, you know that banks must perform two functions, that is accepting deposit and lending of money. So if any institution which is dealing in finance and whose main source of income is from finance only, but it is not performing these two functions, is called as NBFCs. So regarding the regulation, that who regulates these institutions, these are regulated by the sector to which they belong. For example, if there is some insurance company, so that would be regulated by the regulatory authority, that is IRDA. And these are some types of NBFCs, that is asset finance company, which carries on the business of financing of physical asset, investment company, its main business is acquisition of shares, loan company, infrastructure finance companies, and factors, that is those which are engaged in the business of factoring. The second component of financial system is the financial markets. So these are the markets where the trading of the financial instruments takes place. It is not necessary that it has to be a physical place. We see that trading takes place in online mode. Further, these are categorized as money market and capital market. Money market is a market which deals in short-term securities. What and how do we define short-term securities? That is those which deal with less than 1 year, which deal in the securities having a span of less than 1 year. And they bring equilibrium in the demand and supply of short-term funds. They enhance the liquidity, and it also consists of several sub-markets. Talking about capital market, they deal in long-term securities, that is period more than 1 year, and these are responsible for capital formation, and these can be primary market and secondary market. The primary market is that market where the securities are traded for the first time. Like when we talk about IPO, that is a part of primary market. Financial instruments are the instruments which are used for raising the resources. There can be capital market instruments and money market instruments. So the instruments which deal in the capital market, which are used in the capital market, are capital market instruments, and so are money market instruments. Financial services are concerned with providing finance, and it also leads to the development of the economy. There are certain fund-based and fee-based services. This is the list about the financial services. So overall, you will conclude that financial system plays a vital role in economic development. It intermediates the flow of funds belonging to those who save a part of their income and those who invest in productive assets. So undoubtedly, efficient working of all components is essential for the efficient working of the whole system.